Hello everyone and welcome to Investing by the Books, a podcast by Redeye. I'm your host, Eddie Palmian, and with me in the studio this time is Henrik Andersson. Henrik was a guest in episode 7, and he also did the interview with William Green in episode 4. Welcome back, Henrik.
Thank you very much. It feels really good to be here this rainy day in Stockholm and spending some quality time with you and our guest today.
It's great to meet you again, and since we have many new listeners, maybe you can tell them a bit about yourself.
Sure. So I've been an analyst and portfolio manager for 20 plus years, and today manage a concentrated low turnover global equity fund, and consider myself very lucky to having gotten somewhat of a head start into this business through my college education at University of Nebraska. And if there is one audience that knows about Nebraska, apart from college football fanatics and people in the corn industry, it's for sure the one listening today, I believe.
Definitely. And for those wondering, how come you are here instead of Niklas?
Well, that's one very good question. I happen to be a vivid reader of not only investment books, but also great market letters from investors. So I believe it was around 2007 or so when I first found Smead Funds, which was founded by Bill Smead. And I really loved their writing, or missives as they call them, both for the writing itself. It's eloquent, clever, and with frequent references to lyrics and music. And those lyrics, oddly enough, seem to explain markets and stocks quite a bit. So later I reached out to both Bill and his son Cole, that also works in the business, and we started exchanging emails and ideas and stock tips and so forth. And eventually we actually met here in Stockholm at a lunch when they were on a business trip here.
So I have to say thank you for introducing Cole to us, and looking forward to have this conversation today. So which book has he selected for the episode today?
So Cole and his father has a very rich and wide-ranging library to choose from, especially since he talks about books quite a bit in their own podcast. But the one that eventually made it to the finish line first is the one and only Money Masters.
Money Masters was written by John Train and first published in 1980, with several later editions featuring more investors. We are delighted to discuss it with the CEO and portfolio manager of Smead Capital Management. Here comes our conversation with Cole Smead. Hi Cole, and welcome to Investing by the Books podcast.
Thank you for having me. I apologize for my voice today.
It's great to have you on, and thank you for taking the time despite your cold. But where are you located today?
I'm in Phoenix, Arizona.
Is it the office or home office, or where are you?
This is our podcast studio I'm sitting in, which is an old office turned podcast studio.
Nice. And to begin, maybe you can tell our listeners about your journey into investing and life.
Yeah, so I'm in a little weird because, I grew up with a dad who picked stocks, which is just, that's not common. I have a very, strange path in this, which is that, in effect, I was blessed to have a discipline to kind of come into life with. My dad has been managing, his investment discipline since the early 90s. So I had this opportunity where I had undergirdings, I had, teaching that most people don't walk into. I'll never forget, when I was in high school, the tech bubble was raging my sophomore year of high school. And it really crystallized what investing is to me. In other words, we all have to kind of seek out, what is investing to us? Who are we as people? What are our temperaments? What do we do well with? What do we not do well with? And, I think watching that episode of Markets really taught me that being opposed to people is where I can have a lot of success. And I know that sounds weird to say, like being in the opposition. In other words, I'm not likely to be a person that can walk around and agree with a lot of people and make money. I need to find situations, markets, places where I'm doing something different because I actually feel more comfortable there. So I'll like as an example, back then, I was playing, high school sports. And so these parents would run into my dad and I would hear these conversations. where they're talking to him about, what he's buying in stocks, and they want to talk about the hot stocks of the day. And they were all .com names. And the reality was those people were talking about their misery. They didn't know it at the time, but it was their coming misery. And I had a teacher in high school who, God bless him, he's a very nice guy, but he would want to talk stocks in between class. I mean, I'm 16 years old, and he wants to talk to a 16-year-old about stocks. At the same time, I would tell him, I'll call him Mr. B for lack of a better term. I said, Mr. B, you need to go away from this. This is just going to end up in damage. And I didn't know that as an experienced human. I knew that as someone that had someone close to me, my dad, who had really taught me, what investing is, how much damage can be wrought upon someone for what goes wrong. And I think it really also teaches beyond, who I am as an investor. I think the other thing it teaches is most of investing success is actually just not doing stupid things. In other words, you're not doing something magically. You're not making a decision that no others made. You're actually eliminating negatives, which sounds really weird to say, but a lot of investing is a negative art. Think of whether we're talking about stock picking or someone investing in a private business. How do you eliminate bad things? That usually creates a lot of success.
I agree, and I also think there is something that you have innate, something that you're probably born with, and you have this kind of money mind that, it's also mentioned in the book that we're going to speak about today. And we know Robert Hagstrom has written a book about Buffett. And today when I entered the studio, his first comment was about the microphones we have here, the brand. Oh, they have a big market share, and you have this kind of thinking. Have you also had this, like from an early age, this money mind?
Well, so I told this story before. So we drive into a small town. You're on family vacation, kind of classic, stereotypical American road trip, right? So you're driving into a town, and Dad will turn to us all and say, "Hey, what business would you want to own?" And when you're younger, you're like, "Oh, the candy store, the toy store." You're a kid, and Dad's like, "No, that's not no, guys. You want to own the local beer distributor. You want to own the local Coca-Cola bottling company. You want to own the mortuary. You want consistent businesses." Now, he's saying that irrespective of price. Okay. In other words, he's not getting a quota price, but generally speaking, that is right. You want a consistent business. It's an easily understandable way to get wealthy. And so he would be drilling that into our head at a young age. Now, I still think about that today. So for example, walk into a room, there's no prices. They give you options, and you're going to pick the most consistent business. I actually had this happen like a week and a half ago. I just wrote on this. I went to a Kentucky Derby party. Okay. And I show up at the party, and there were no odds being given on the horses at this party. Okay. So like showing up in a small town, if there's no odds, in other words, you don't know what you can make for taking extra risk, what are you going to do? You're going to bet on the companies Dad said. You're going to bet on the Coca-Cola bottler, the beer distributor. In horse racing, it's the favorites. You bet on the favorites because there's no odds. Okay. So I did. I took $100. I bet the top four favorites, and you just got paid. It was like half the pot for win, a third of the pot for second, and a sixth of the pot for who came in third. Well, so Mage won. Mage was a long shot. Again, you didn't get compensated for the long shot, but so a longer shot won. But two of the four favorites ended up getting second, third. Okay, now here's the great part. I put $100 in. You could get diluted. I actually provided investment advice. I know you guys would be shocked to find that out. I advise other people to follow my strategy. So I put $100 in. I made $110. Hey, I made 10% of my money. We had a wonderful party. Life is good. So I say that because those principles that Dad put in my head, I still think about them all the time. They still apply. I just used them a week and a half ago, but it's that framework. And to your point, it is a money mind, like you were talking about with Henrik walking in and thinking about the mics. I think of how often I run into people, classmates, parents of my kids, and I say, "Oh, what do you do for a living?" And I'm intrigued to learn, what do they do? How do they do it? How are they capitalized? What's tough in their industry? Who's their biggest competitor? Those are all incredibly interesting things to think about.
It sounds like you really had the right curiosity, but also that you have had some help from from being close to your dad early on and learning a lot. It's quite interesting in the book. I mean, we will go into it, but he describes it that many great investors are born poor, or at least not very rich. What's your view on that then?
Yeah, I look at that as it's really, I think it's your point, back to the person. Like, for example, this sounds weird to say, but again, I've thought a lot about myself relative to my father, if that makes sense. Okay. And it's a weird thing to do. So I would tell you, this is the funny part. I'm 70% my father and 30% my mother. Okay. The fact that I'm listening to you guys, and I'll remember this in a couple of days, means I have my mother in me. Also, my mother loses her voice often. Here I am, losing my voice. So I know I have my mother in me. But here's why I say it. There's little idiosyncratic things you pick up on when I sit next to my dad. We talk all day. He's actually in Europe right now on a business trip, and we're still trading emails, talking, etc. But here's the weird part. I can tell subtle differences. So, for example, my dad wants to be validated. In other words, he wants, like, let's say he joined your podcast. He'd want you to say, gosh, Bill, you've done so well. And that would be his highest esteem, okay? Versus me, I want to get on a podcast like this and you say, gosh, Cole, you've made so much money. In other words, like, the wealth that's been accumulated, in my mind, is the actual goal, not you telling me, gosh, you've done well. Because if I've created a lot of wealth for our investors, I know I've done well, right? And I know that sounds really subtly different, but they're vastly different than each other. It's how my pleasure comes in the wealth accrual process. His pleasure comes in the accolade of success. And those are different. And again, those are two different things that drive us differently. And so it's like we're very similar people. We have a lot in common. Like you said, I'm blessed to have been born into the ability to go do this. But here's the weird thing. I have 2 brothers, 2 sisters. None of them do this, right? So that didn't drive them like it drove me. And so I think about those idiosyncratic differences. How did I get here? Why did I do this? I mean, thank God I'm not playing baseball. That'd be a miserable profession, for example. Thank God I'm not flying Navy jets. Those were the other 2 things as a kid I wanted to do. And I look at it as, does that mean I couldn't have been successful? No, it's just not what God wanted me to do.
And now you are here, an investor and a big reader, and we're here to talk about the book Money Masters by John Train.
Yeah.
So which edition do you have, and when did you read it for the first time?
I read this years ago. So someone stole my original copy. To your point, these books are hard to come by. And let's see, this is the 1980 copyright edition. Let's see. Yeah. So so a little weird. I don't know if you guys have had this experience. These books are going up precipitously in value. Okay. In other words, like your podcasts like ours. I mean, the longer we go, these books become like what used to be like baseball trading cards here in the United States, where it's like a collector's edition because this book isn't in print and no one's, he did an update of the book and it's like the new Money Masters. This is like, this is the richer, wiser, happier of its era, if you will. And so I find it interesting that you can buy these books, you wake up in 5 years and they've doubled in value. It's a tiny market, right? So we can't really run a hedge fund based on this, but there's value.
Yeah, or at least the price goes up.
Yeah, exactly.
So when did you read it for the first time?
I read The Money Masters. This will go about 8 years ago is when I originally read the book. And there are aspects of this book that you can capture elsewhere. So like the Buffett stories, there's a lot of other places you can get those stories. I don't look at the Buffett part or really the Graham part as the secret sauce of this book. I would look and say it's a gateway drug to John Templeton. Like if you read this and you're captured, there are certain kernels you'll find in this book that you can't find elsewhere. For example, the Templeton Growth Fund, it was not a US-based mutual fund. It was a Canadian fund. So it tells a little bit of a story about moving to Lyford Cay and being in the Bahamas. I find that very interesting. It rehashes his story of buying penny stocks, which everybody knows. You can also Lauren Templeton in her husband's book, Investing the Templeton Way, recants that probably better. But I think that the most interesting chapter is chapter 7. And chapter 7 is T. Rowe Price. And when we hear T. Rowe Price today, we think, oh, that's that blue chip quality growth shop in the United States of America. And it is. But T. Rowe Price, the man, was vastly different than T. Rowe Price, the money management firm. And I think that studying that is the most interesting chapter of this book.
We'll go a bit deeper into the lessons from him. But first, the author of the book is John Train. Can you say a few words about him?
Yeah, so John Train, I think of, to give another era, John Train would have been like the John Brooks, if you've ever read the Go-Go Years. He would have been a formidable New York writer of the time, and was very well known when this book was published. And you got to remember that the 60s were a hot stock era. So the likes of a John Train coming out of that era, this was a known quantity author. To give it an example, Spencer Jacob wrote The Revolution That Wasn't. He's the Herd on the Street Wall Street Journal columnist. It would be a writer like that coming out with this book to talk about, post what we just saw in stocks, what had transpired. And so John Train would be an iconic name for then. Now we don't know who John Train is. Most people say, oh, John Train. Other than this book, this is really his epitaph in so many respects. This is his legacy. And so I find it interesting that you don't hear that name outside of that, much like, unless you've read the 1960s book, others like John Brooks would never be known.
Yeah, I agree. And actually, John Train, he wrote about 25 books in total. But as you say, this is the most famous. And he was born in 1928 and he died in August 2022. So it's good that we can discuss this book with you now that he's not with us. And the book, it covers a number of the greatest money masters, as he calls them at the time. And he has included them in a bit different way. Maybe you can describe the structure and how John Train is showing their style and what is every chapter about? How does he make them?
Yeah, so what he does is he goes through, he structures it a lot like William Green's book, Richer, Wiser, Happier. He goes through a series of chapters based on investors. And now, here's what's interesting. Studying the test of time, what chapters mattered? I think that's a really interesting thing to think about. So, for example, to your point, to go through the list of investors, he goes through Warren Buffett, he goes through Paul Cabot, Phil Fisher, Ben Graham, Stanley Kroll, T. Rowe Price, Sir John Templeton, Larry Tisch, and Robert Wilson. Okay, now, if we break it down and say who mattered, here we are in 2022. Who mattered? Who mattered was Warren Buffett, Phil Fisher, Ben Graham, T. Rowe Price, Sir John Templeton, and maybe Larry Tisch. That's who mattered. Okay. Now, why did the others not matter? Well, because they didn't end up being the outstanding investors that the people I just mentioned were. And really, in some respects, you could say that Ben Graham's lineage is really just Buffett. In other words, Ben Graham did well for his time, but he blew up quite a few times. So I point that out because Ben Graham, his par excellence as a teacher is really why we study him. He was less successful as an investor, but what he did as an offshoot has obviously changed the world.
And also a lot thanks to Buffett highlighting him. We recently spoke about Roger Murray, the professor that took over after Ben Graham at Columbia. And he is, almost no one knows about him, but he was also very important for many, many investors such as Gabelli. But Buffett highlighting Graham has really made him so famous. Yeah, and of course also his books.
I agree.
So who would you like to highlight a bit more?
Well, I think that the T. Rowe Price chapter is just remarkable. So, we all know T. Rowe Price for the money management purposes. It is the big blue chip quality growth shop that we all know today. And so T. Rowe Price, or he called himself Rowe Price, is how he referred to himself, was the creator of that. He created the T. Rowe Price Growth Stock Fund. He then, after launching that, went on to launch the New Horizons Fund, which is maybe the most popular T. Rowe Price fund of all time. And then after that, he launched the New Era Fund. So he was an interesting person. If you just reading through the lens of John Train, he was probably tough to work with. In other words, he was a great investor, But if he figured out you were competing, he would eviscerate you. And John Train made that obvious. So he called it he was irascible. He was this very excited, successful investor. He would call up on the phone and say, "Well, do you know who I am?" In other words, like there should be like chariots preceding his call and calling out to you to say, "Rowe Price is calling. You better be ready." So so again, I'm framing this as I'm interested in him for what he did as an investor. Would I want to work with him? No. Which is I'm sure we've all met people that are, as I say about pro athletes, they're good from far, but they're far from good. Okay. In other words, like you want distance, you don't want to get to know them very closely, because if you did, you might be disappointed. But an incredible investor, and really what we know and think of as like blue chip quality investing today, I would really say that T. Rowe Price laid out the foundations of that. In other words, the consistency of a business, that principle, I think he understood really well. And what he did, I think successfully, was waited till they were in the doldrums, waited till those types of businesses had fallen way off. He also knew the difference between, a consistent growth business. In other words, like I'll use like a staple, like a Coca-Cola, kind of a consistent business, versus what he referred to as a cyclical growth company. And when I say cyclical growth, you think of like a PACCAR, for example, where it is cyclical, but over time, peak to peak, trough to trough, it has consistently grown its business. And he points out that you have to weigh those things differently. You can make money differently in those two subjects, but you have to weigh them differently, because obviously a cyclical business doesn't have the same merit as a consistent business. Back to the principle that I mentioned that my dad touched on when I was young. So I think those ideas are throughout this chapter. I think they're a great primer to understand really, kind of quality, but really quality with consistent growth. To give another example, when I read this chapter, I think of, in a present day, I think of someone like a Terry Smith of Funsmith fame, for example. Now, when we can get into this, but his pivot that he does, that John Train talks about later in the chapter, I think is by far the most interesting part. Because how do you go, back to what you said earlier, Henrik, flexibility, or kind of the pragmatism. Like you think of Charlie Munger. Charlie Munger is like the ultimate pragmatist, right? Like when asked to comment on Elon Musk, he says, "I think he's brilliant sometimes." Right. And so I think there's a pragmatism that you'll find in T. Rowe Price that I think you'll rarely find in investors. And I know that's strange to say again, but he was a pragmatist to the point where, again, his sole goal was to be successful. It wasn't to be right about the things he was right about yesterday.
But I think that's something that goes through all through the book. I mean, in one of the main lessons is that this importance of you need to be flexible and you need to adapt to the changing times. I mean, when you read the different investors, they say it, and also John Train highlights it in the book. But you also need to avoid falling for the herd behavior. So how do you think about that?
Yeah, so in the prior chapter, in chapter 6, Sir John Templeton touches on that numerous times. Flexibility. And he was doing that in an era where, he was the first ever global stock fund in America. Just think about that. First ever. So here he is buying Japanese stocks in the 60s when nobody wants to touch anything tied to Japan, versus when they all, to your point about the herd, in the late 1980s when everyone was falling all over for Japan, he was sitting in the United States by then. So I agree with you. And here's what I think about a lot today. What does the herd love? So to your point, T. Rowe Price, and by the way, like in all good financial statements, the footnotes in chapter 7 are amazing. There's 2 of them. You should read the footnotes. So T. Rowe Price was watching his old firm. He was watching others like Morgan Guarantee, which was they coined the Nifty 50. Okay. That was the, blue chip quality growth, Nifty 50 shop. And then the other, here's a crazy one, US Trust. So now here's the weird part. We're talking about 2 trust businesses and a blue chip money management firm getting tied up in a mania, because the Nifty 50 was a mania. Okay. And if you go back and study the market history, there was a nasty bear market in 1969. If you go back and study that, and by the way, John Brooks, The Go-Go Years, is a wonderful book for studying the 1960s. That crushed the average investor in 1969. Individual investors left public markets with the 69 bear market. By the time you got to 1972, where T. Rowe Price would have been railing against what his former colleagues were doing, that was a professional only market. But again, it wasn't like racy stockbrokers. These were trust businesses. These are like who grandma walks into the door with and has her, in today's terms, like her $10 million trust account. And these were people that were supposed to be steady Eddie, very blue chip, etc. And what it exposes is that you can take, back to the principle earlier, you could take the most consistent businesses in the world and you could damage investors at the wrong prices. And by the way, I think that could not be, there's nothing so apropos to today, okay? Because let's go look, we often look, a way of looking at this is go look at the 10 largest market caps in the world today, okay? Historically speaking, and I wrote about this back to my Kentucky Derby thing, those are the favorites, right? Those are the perceived favorites in the era ahead. Now, the great part about the stock market is they give you odds, right? The stock market is there to give you odds, like all betting houses. And those favorites are a terrible investment return over and over and over. And the crazy part is people still love betting the favorites. So if you go through that list today, it is loaded with blue chip quality American companies, right? It is Microsoft. It is Google. Those are all the blue chips of our era. Who will recommend them? Every mom and pop wealth management firm, brokerage firm, trust business, etc. And that's the problem, is they're the favorites. They're not unique. And isn't it interesting? They're thought to be low risk, just like the Nifty 50 were. I'll give you an example. If you go one step further and you go into study the Nifty 50, and this would be like, I look at John Train's book, it's a gateway drug. It's a gateway drug. You read this and you're like, I'm perplexed about T. Rowe. Let me go deeper. So then you go to John Brooks' book, The Go-Go Years, and you get into it and you learn about a business called Simplicity Patterns. It was a knitting business, okay? A knitting business. Now here's what's weird. No debt, produced very high return on equity, like 25, 30% return on equity, which for that year would have been incredible. Great growth business, women knitted, okay? So you think about all the things we talk about in a current business, it fit many of the things that people look for as investors. Now, by the way, the fact that you don't know about the business today means that something went wrong. Something went wrong in how investors thought about it because they way overpaid for a business like that. And that's what that was the kind of things that T. Rowe was screaming against. It's not a question of whether there's attributes of these businesses that are valuable. It's that we're in a different era and people are paying way too high prices. And so I think that's the real damage. It's not the business. It's price. It's the price that people are willing to pay for these companies. And again, I would say that is what's gone on in this era. And by the way, some might say, well, this hasn't been like 72 to 74. I'd be like, well, you're implying that it's over.
Do you have something to comment there, Henrik?
No, I just like the name of that business. Sounds enticing, right, right off the bat. But it was too enticing, I guess, at the time.
Well, also, I mean, like he's got I think if you go to the Sir John Templeton chapter, he talks about a business called Wells Green, which was a advertising business. And to your point, the worst part about business is businesses are actually always dying. Okay, so think about it like this. Okay, I'm going to use a Mungerism, if you will. Someone said to me, Cole, does it bother you that some of the businesses you invest in are dying? And I said, well, who's the fool? Is the fool the person that knows that, or the fool the person that doesn't believe that's so? Okay? When a business is born, it is in the process of dying. Okay? And I know that's really weird, but you're just trying to find the expiration. That's all you're trying to figure out. Is it 2 years into the business? Great. It never succeeded in some respects. If it's 100 years later, it succeeded, but it still died.
I know I have Googled this before, like which is the oldest company in the world. And I think it's some Japanese company that's still been around for 1,000 years or so, but it's a very rare exception, I guess.
Well, now, and then the second question is, would you have wanted to be an owner of that?
Probably not.
Probably not. Yeah, that's the funny part is like, would you want to have been an owner? So, I mean, just think of, when we were kids, GE would have been a blue chip creme de la creme business. Now, when in 1995, that would have been, to say you own that, you never would have got criticized. But to say you own that today, you do get criticized. So again, I think we tend to practice chronological snobbery. We look back and say, oh, it was, there was so much dumber back then. No, the 72 to 74 bear market that Rowe Price is talking about, that was back when we didn't have behavioral finance and we didn't have Daniel Kahneman's work and we didn't have all this stuff. And the answer is, well, we didn't have, Kahneman's work, I agree. But you're assuming that just because Kahneman has spoken, is God has fixed humans. And that has not happened yet. So that's the problem, is humanity can't get past itself, which the good part for you guys and myself is it's called job security. That's why we make money. If people don't do dumb things, how can you profit from it?
And I think this is a good argument to listen to our podcast and read these type of books. I mean,
Agreed.
As you speak about John Brooks, I mean, his first book, or the one that's covering the time between the two world wars. I don't know if you read it, Once in Golconda. I think it's similar to Go-Go Years, like bringing up so many business names that you have never heard about today, but they existed back then and they were quite big.
Well, and I mean, because I look at, so I analogously think about things. So John Brooks, he was the Michael Lewis of that era. Okay. He was the writer that, again, similar to John Train in that he was in the New York scene, but he was more known. John Brooks was a more well-known writer, I would argue, than John Train. But again, the history lesson, to go back to 50-year-old books, I mean, this is timeless stuff. You cannot find this. No one was going to tell you this. You can't read a research report that says this. In the VC world, no one's going to be like, hey, let's go back and study other young businesses that just were about to enter public markets, or what was the scene like at that time. You just can't find this kind of stuff today.
And coming back to Rowe Price, is there something you don't agree with him?
Well, I mean, by nature, he would be willing to take a lot more risk as it pertains to a young business, I think. Now, that being said, he was looking for the same attributes we would. We want a business that can produce a very high return on equity. And by the way, if it can so happen to do that in a self-funding way, where that return on equity not only self-funds, but then is growing, has the potential to grow. Here's an example. We were, as we were watching this banking debacle go on in the United States of America, we jumped on a call with a bank who's had insider buying, things that we look for. By the way, Templeton in this book, he loved insider buying. So one of the questions I asked them was, hey, you've ran 20% return on equity the last few years. What would help us understand that you can sustain that or grow that? Versus the history of their businesses, they often fall off to maybe 15% return on equity more normally, or at low points run 10% return on equity. And their book multiples on their bank fluctuates with those return on equity numbers. At the low end, they trade for 1.5 times book. At the high end, they trade for 3 times book. So these are just like, again, you're just looking at odds, return on capital, etc. And his answer was, well, we don't target return. Now, if Rowe Price hears that, he's going, well, I do. I look at return on invested capital, which is something he points out in the chapter. And so immediately it would be the kind of thing where both him and I would say, hey, there's a problem. That's something we want to focus on as an investor. And these people don't care. We're not aligned. Back to, Munger's incentives. We're just not aligned on that. So I think that's where we would have a lot in common. I think Rowe would be willing to pay a lot higher multiples. I think where we would disagree the most is not the blue chip businesses. It's the younger businesses, the less proven businesses. So I think that's where I would disagree with him. But again, back to our prior conversation, his ability to pivot, if you look at his book, I think if I remember correctly, he ended up with like a third of his portfolio in like what most growth stock investors would consider garbage businesses, right? I mean, like I'll use Terry Smith. Okay, Terry Smith, would never own what T. Rowe ends up owning during the 1970s. We're talking about natural resources business. We're talking about gold and silver companies. I mean, to put it in American politics, those are referred to as the deplorables most often in the investment business. But here's what's interesting. The 1960s, really, if you go back and study it, 66 was the relative high in growth stocks. You made a higher high in 69, you made a higher high in 72, but nothing to write home about. It was marginal highs. And the 70s became a dominant era of oil company outperformance, commodity business outperformance, gold outperformance, everything that T. Rowe Price pivoted to. So I asked the question, what kind of person can do that? What kind of person can make that pragmatic pivot and do that at the odds of what they're known for? In other words, T. Rowe Price was a growth name. It still is a growth name. I mean, nobody outside of John Train's book, you'd never know this about T. Rowe. And by the way, I don't think the folks at T. Rowe Price want most people to unearth this either. It's not in their brand's best interest. But I'm interested because I want to make the most money. I want to steward and use an old term, husband capital the best. And that would imply that, to your point earlier, like John Templeton says in the book, the flexibility like T. Rowe Price exhibits in his career and in his life. The worst part is he didn't start a money management firm and go put this in a track record, because he did it in his personal accounts, is what the book explains. But he made substantial profits. Now, substantial profits in an era where investors lost money in stocks. Okay? So in other words, by the way, if you go one step deeper, Buffett had a terrible run, 69, from the end of 69 to the end of 74. That was a terrible run for 5 years of Buffett. If you go elsewhere, Sequoia Fund launched because Buffett closed his partnerships in 69. And this book mentions Buffett closing his partnerships. And if you go read Buffett's writing at the time, he said, I knew what the game was about and I didn't want anything to do with it. That's when he became just solely the chairman of Berkshire Hathaway. Well, when he closed the partnership, he sent him off to Sequoia Fund. And that's why Bill Ruane launched the Sequoia Fund. So Sequoia Fund was launched in July of 70. Guess what? Sequoia Fund did terrible to the bottom in 74. Okay? So Buffett underperformed, Sequoia Fund underperformed, and here's T. Rowe Price killing it in a nasty, nasty bear market. Now, by the way, oil, if you study oil had a great first 5 years of the 70s, and then Buffett remarkably matched or beat oil in the latter part of the 70s. And so, again, I look through this book, look through the lens of what it teaches, and look and say, okay, you want to be T. Rowe Price in an era like today. You want to go find businesses that nobody wants to own because they're so antithetical to the rearview mirror. Or Sir John Templeton had a lot of success in the early 1970s. That chapter 6, study chapter 6. I mean, those two chapters combined, those are formative in an era like today, I would argue. But even Buffett, it's like here we have Buffett filing over the weekend that he bought more Oxy. Okay, he filed on Monday. Okay, so let's say we're in the Berkshire offices. Okay, I'm the fly on the wall. You're Charlie, you're Warren. Okay, and I'm like, all right, what do I think they're talking about? And so I come back to the world as the fly on the wall. Here's what I think they're talking about. They're looking, saying, Charlie and Warren are going. Charlie looks at Warren and goes, Warren, you remember how hard we worked in the early 1970s? And we ended up having our best decade ever. They did. But gosh, we had to work so damn hard. That's my Mungerism. So damn hard. And Warren says, yeah. And then Munger says, you know what? I prefer to sit on my ass. Because if you sat on your, in Munger terms, ass in the 1970s, you would have actually gone long oil and almost done nothing else. I know that sounds overly simplistic, and it is. But to put it like Munger would say, I think it's right. And so here they are. They're saying, why work as hard as we did in the early 70s to tread water or get back to what we did by the late 70s? Why don't we just own an investment that we know is likely to be superior and we don't have to think very much about it? I mean, they sold out of some Chevron. Here they just continue to buy Oxy. They continue to just buy and buy and buy. So I look at their Oxy ownership, and I look back at books like this and think of the 70s, think of Rowe Price, think of the pivot he made, think of what Sir John Templeton was doing. Those were just antithetical things to what investors wanted to do. Now, where else can you apply this? Go find things that other people will not own for whatever reason. So, for example, there is something called ESG in this world, okay? And some people have to live in light of that, but not all people do. And like the book shows commonly, I think the small investor does have a big upper hand advantage in this. If you don't have mandates on your life, the flexibility is more inherent. And so I look at ESG as a godsend for people like us as investors, or people like the T. Rowes of that era. Because if you have certain mandates tied to you, that limits what you can do, but that doesn't decide the value of something. That just tells you what you can or can't own. And so I think there are added wrinkles in this era that you have to overlay, even compared to a T. Rowe Price 1970s era.
And I think one part is the requirements that you have in the fund or whatever portfolio you're running. But one is also your perception, your identity.
Correct.
I am this type of investor. And for T. Rowe Price, I mean, people were really skeptical when he made this move, as you said. I mean, people were saying, but you're supposed to invest in T. Rowe Price stocks. This is a T. Rowe Price stock.
Yeah.
Why are you not owning it? You're leaving this one.
Exactly. Well, and so Henrik will be able to appreciate this. So I love this, by the way. I think we're really flexible people. My wife would say I'm not. But so here's why I say it. Back in 2011, we as a firm, we were as negative as you could be on commodities, oil, the China story at large. Okay. Now, why? We had came across a chart. I'll give Barry Bannister credit for this, but we had came across a chart that showed the 205-year rolling returns in stocks versus commodities, and commodities had never done so well relative to stocks. So, to your point, what does that teach you? It teaches you what not to do, right? So we own nothing in commodities. We own nothing in energy. We sat there for a decade plus. I mean, by the way, long before any of the ESG mandates have limited a lot of investors in those arenas. Now, wake up in 2023, but really the last couple of years. We own, in some respects, all the assets that we had avoided in the prior era. Now, why? Because the merits of the price and the businesses that we got that you couldn't get at that prior time. So, what T. Rowe Price was doing prior was saying, in the 60s, here's the type of businesses that I found of value. They were growth businesses. They were consistent blue chip growth businesses, things of those nature. And then when those became unattractive, he pivoted to the non-T. Rowe Price stocks, to your point. And now the question is, who's willing to do that? As an example, I kind of mentioned Terry a couple of times. Terry has made it very known that he will not own an oil company. He will not. Okay. And by the way, I think one of the more damaging things that investors can say, particularly in an era like this, is never. Never. Because if you're required to have flexibility, never is a terrible word. Okay. What if God sets up a circumstance in common stock markets where you had to have 100% of your portfolio in utilities that produce bad returns because everything else was more stupidly priced? Would I ever want to come to an investor and say, I'll never own utilities? Now, generally speaking, do I want to own a utility business? No. But I could damage capital by telling people never. Here's the other damaging thing about saying never is you wake up in a later era where you have to own that. You have to. The merits are just too great. And you've told everybody you'll never. And so the question is, well, are you sticking to your discipline or not? Right? So, Terry at one time said, I would never own Facebook. I would never own Google. And isn't it funny? What does Terry own? The things he would never own. And again, as pragmatists and as humans, I think it's very damaging to go out and say never. Now, to your point, there are businesses we will not own, but these are not for investment reasons. We will not own a tobacco producer. Why? Not because it's a sin, but because I don't want to own a company that ruins the life of their best customer. My grandmother died early smoking cigarettes. I don't think it's that big of a deal, by the way. But to honor my father and mother, I'm not going to own that because my dad wouldn't either. It's a way I look and say, it's a way I can honor my father and mother in what I do in my investing. I don't want to own an alcohol business, not because I don't like alcohol. I love alcohol. There's nothing wrong with it. I love a good old fashioned, but it's just not a business I want to own. Same with pornography. I think pornography damages families, ruins lives. It's just not good for humanity. So we willfully choose not to own those kind of businesses. But here's the weird part. You'll never find that in our materials. Those are personal decisions we made. And that's not like I'll never own it, but if it gets really attractive, I won't. Most things that people say never on right now, it's for investment purposes. It's not ideological or religious purposes. They say that. It's I'll never own this because that's a superfluous business. And then you wake up later and they're like, well, it's not so superfluous, is it?
So, Cole, that brings us perfect into the next part of this discussion. Not Cole the reader, but Cole the CEO of and portfolio manager of Smead Capital Management. Was the you mentioned before that you were the one in the family that sort of got more attracted to this line of business than your siblings. Was the pathway to that career always laid out clearly for you, or when did it really strike you?
Yeah, the answer is no. In other words, I knew, to your point, Henrik, I knew I wanted to go in the investment business. What I did in the investment business, I didn't know. That's the part I didn't know. Now, so again, negative arts. Negative arts are how you learn. That's how you deduce things, if you will. So I took my first job out of college as a financial advisor with Wachovia Securities, now part of Wells Fargo Advisors. And what I learned really quickly is that I loved the investment business. I love stocks. I was not called to deal with private clients. In other words, I can understand the rationale and logic of someone wanting to do that, but I want to invest capital. I want to grow capital. Trying to help everyone figure that out, that might not be my job. Doesn't mean I don't want to communicate, but do I want to own bonds for someone? Do I want to do all the other things that came with? The answer is no. I just had no interest in it. So, I did that. And then what happened is Dad was going to start the business. And so I looked and said, you know what? Great. Now, how did I evolve in that? Well, you wake up, you show up, and you say, great, Dad's starting a business. I know this discipline really well. I can talk about it with investors. We need to raise capital. So that was my initial role. How do you raise capital? Now, by the way, I'm so glad. I'm so glad I got to do that. And the reason being is that it's like Buffett says, I'm a better investor because I'm a business person, and I'm a better business person because I'm an investor. So learning how to raise capital has been incredibly valuable to me as an investor to think about what's the process for a business that's growing. What's a process for a business that needs to get to a bigger size in what they do in revenue and things of that nature? But further from that, as I move forward, I went to the CFA program. My only financial accounting experience or training came through the CFA program. Now, by the way, I consider myself a financial accounting savant. I love financial accounting. I think it's super sexy. I think it is magical because you can almost do anything you want with it. Okay. And that's why I love financial accounting versus I would never want to touch managerial accounting. It would be boring. I don't want to do credits and debits. It's not sexy. Okay. But the CFA program is the only thing I had to teach me balance sheet analysis. I was an econ history double major in college. So I'd never taken an accounting class until I got in the CFA program. But as I moved forward, I went from raising money for a business to then, working solely on the investment side of our business. And then eventually, being the CEO of our business. So I would say like 10 to 15% of my day would be tied to things of the business versus sitting down, talking about what do we own? What do we find attractive? What are their insider buying? What can we get through our 8 criteria? What fails automatically? Those kind of things. That's where I spend most of my time. And again, I'll give you an ideological thing that's really helped me. We're in a current state of our business where we're growing. So we're making OpEx investments to grow. Now, OpEx in our business is CapEx to other businesses that have tangible assets. So I point that out because I know right now we're running lower earnings or free cash flow as a business to grow. Well, that's good to understand in our business because I can apply that to public stock markets where other businesses are using that same thing. They could be running higher profitability, but they're choosing to grow. Most, I'll call it most, investors, most value people never understand that, because also they don't run their money management firm either. And so I think that's a valuable thing, that as we run our business, as we do these things, that what we feel we need to have success, there's as much to learn inside of our business as, say, a VC business would be learning, for example, or a company that's growing in the public stock market. We have less in common with a stable business because we don't run ourselves like a stable business.
Not sure if your dad is an avid podcast listener, but let's pretend he's not for the next question. Growing up or getting into the business, who were your greatest investment heroes?
So I'll give you, like, when I was getting out of college, Bill Miller was like the end all. I mean, he was, and so I got out of college in 2006. Here's Bill Miller, just killed the market for 15 years. I mean, so I'm to this day, I'm a huge fan of Bill's. I think he's incredibly brilliant. I look at him as like, in my mind, his eccentricities, he's kind of like a Benjamin Franklin type. He's just very eccentric. His mind wanders. And I have huge respect for Bill. My dad and I, this is back in 2011 or 12. We were in Baltimore at the time. Bill was still with Legg Mason. It was where he was running Legg Mason Miller. He was still part of Legg Mason at that point. And so we were like, you know what? We got extra time in Baltimore. Let's go see Bill Miller. And for me, this was like, oh my gosh, it's like, I'm going to the pearly gates. I'm meeting with St. Peter, right? And so he was just a real treasure. Spent some time with him and his what was his co-PM then, now runs the Legg Mason Opportunity Fund, Samantha McLemore. And so visited with them. And at the time, what we talked about was home builders, because home building was on its back. Okay. And I'll never forget this. I love this. Classic Bill Miller. So Bill must have looked at our stuff or looked at our criteria before. And, we said, listen, we have 8 criteria. And we said, Bill, the one thing we can't get past in most of the home builders, the one exception at that time was NVR. We said the one thing we can't get past is the balance sheet of these home builders. Okay. And he leans over the table, looks across, and he knew we had said we had 8 criteria. And he said, maybe you should only have 7 criteria. I will never forget that. It's one of the greatest lines I've ever heard, among professionals in this industry. Now, here's why I say that. There's still something to learn in what Bill Miller said then. The businesses you wanted to buy then were the worst balance sheets. Now, here's the danger in that. You don't know the future. You could not have foreknown the future. Looking back, that was the after the fact best decision. And by the way, here's what's weird. There is not such a thing as a bad balance sheet in home building today. There is not. Every single home builder can pay off their free cash flow, or pay off their debt with less than 2 years of free cash flow. It's crazy. So Bill Miller was right that the balance sheet was far less questionable if you could look back from 2023, but we didn't have that advantage. We had never owned a home builder up to that point. And so that was a real treasure for me. I'd always admired Bill. I think I've done one other call with Bill. It was the spring of 20. And so here, like, the all hell's breaking loose. And Bill says, listen, this is one of the 5 greatest buying opportunities of the last 50 years. And it was just like, he's right. You got to load the gun. That's the time you had to load the gun. And so I wrote a piece back then called Betting the Long Odds. And it was based on Sir John Templeton throwing $10,000 that you'll find in this book into the market. He borrowed the money. And it wasn't that he knew he was going to be right. But interestingly, if you look back, a lot of people that have studied the stocks he bought, and the stocks he bought, they produced the most wealth because many of them had ran negative, they'd had losses in the prior years, to where when the war picked up, right, the war broke out, the war picked up, and World War II spending took off, tied to the government, they made so much money that they didn't pay cash taxes for years. In other words, all the money fell to the bottom line, to the investors, in the forms of dividends, ultimately. So I think about that a lot because interacting with him and those 2 different advantages, I think back and say, gosh, he taught me something. Bill Miller taught me something in 2011. How did that help us? It helped us a lot in 2020 in oil, right? In other words, you had to have a perception that you needed to be more optimistic than other people were about the capital structure of the oil businesses, because no one could see, to use a Sir John Templeton term, no one could see light at the end of the tunnel. Okay. And Miller had really reinforced that idea in my head after him mocking us in 2011 and 2012. And he was right. And by the way, I'm so glad, like Munger says, you want to rub your nose in your mistakes. Okay? You want to rub your nose in your mistakes. We would have been better off buying the worst balance sheet home builders and sitting through this all the way till today. And you have to put your nose down there and smell it. It doesn't smell good. And you got to learn from those things. And I give a lot of credit to Bill. And again, it's a blessing. To your point on Robert Hagstrom, Robert Hagstrom's been a treasure to interact with. I mean, just the fact that, you guys or we can have conversations and talk about him and have practical, pragmatic discussions. That's incredible. I mean, I cannot believe I get to do that. It's a blessing.
So perfect segue into the next question. I mean, today there are every investor in today's era of Morningstar and style drifts and investment counselors and whatnot. I mean, most investors today swim in the same current, right? You invest in compounders or companies with big moats, etc., etc. But you're different, and you certainly drank the contrarian Kool-Aid or whatever you might call it. So, and I think towards the end of your letters or missives that you call them, for a few years now, you've written "Fear Stock Market Failure." I mean, how did this happen, and how did you keep the flexibility of thinking in your firm?
So I'll give you another book. I'm sorry. It's just how I live my life.
Perfect podcast to do that.
Yeah. So the author's name is Donald Miller. He's kind of like a marketing person. If I remember correctly, the title is Creating a Story Brand is the name of the book. Okay. So here's his thesis. In every great story, there's a hero. But your brand, your company, it cannot be the hero. Right? Like, Henrik, think of how often a money manager, he or her are built up on this pedestal as though they're the hero. And you just know when that happens, it's going to be miserable after, right? So we know it's not even good for the money management business to even imply that they're the hero, because it's like the Sports Illustrated cover problem, right? So we're never the hero. And he points that out. He says, you're the guide. So you can't be Luke Skywalker. You're Obi-Wan. And I think that's really important, because not only is it true in investing, like, I can't be the hero. I can't be the star of the show. It's the investors that have success. They are the hero. But further, from a brand perspective, he pointed out that, that's true of all great storytelling. And therefore, you have to think about your brand in light of that. And so where that fear stock market failure came from is he points out that as you're going to tell your story, if people don't realize that they have a problem, thus they have a need for what you do, why would they care? Why would they care? Right? Like, if you think about it, let's say, let's use the Segway as an example, right? So if you have a Segway, great, I can get around quicker on a Segway. But is my problem that I can't walk around on my own two legs? So, like, why has the Segway not been widely adopted? I would say because there's not really a problem that it's fixing. Versus most people, if you look at the dollar-weighted returns of stocks or investors' dollar-weighted returns, they do terrible. They fail in the stock market. If you go look at Dalbar, for example, most investors fail in the stock market. Who ends up producing most of the success of the stock market? Insiders, right? Because they were forced by nature to be involved in the business, stay involved in it, and not worry about the twos and fro's of the business. So I point that out because, we all have an uncle. We all have a friend. We all have that person who got involved in the stock market and got crushed, and they are skeptical of ever coming back to it. So we look at it as most people fail in the stock market. All we're doing is just recognizing that. There is just as high a likelihood that someone never has success in stocks. And if they don't understand that, then why would they need, to your point, our discipline? Why would they need to do something different? Why would they have any need for that? And so, as an example, we think it was also timely to change our brand to that, Henrik, because we weren't coming out with that at the beginning of a bull market, right? We were coming and saying, hey, this smells, looks, tastes a lot like the late 1960s and plausibly the late 1990s. So what is the higher likelihood today? The higher likelihood today is the stock market failure is going to wreak havoc on investors, good and bad. And therefore, we know that. We know there's a high likelihood of that. And we have a discipline, we have a criteria to deal with those things. And by the way, also like back to the businesses we're buying, we have pivoted like a T. Rowe Price to a different era. The commodity-oriented businesses that we wouldn't have owned in the 2010s, we now own. Now, to your point, is it easy to do that? No, it's not. It's tough. Was it easy to be T. Rowe Price? No, but here's the good part. It was a lot tougher to get us to where we were today, I think, than it is to pivot and make the decisions that we have the last 2 or 3 years. I think the biggest danger is people not doing that. In other words, I would be more scared to be sitting on the big blue chip quality names today than to be sitting in, the oil businesses, let's just say, that we're buying. And so, again, go back to what I said earlier. When I was 16, I learned that being in opposition is a more comfortable place for me as an investor. And so oddly, it's like, this is kind of what God made us for. And our branding, to your point, is just very reflective of that. We do not want to fail in the stock market. We don't want to fall subject to what Buffett and Sequoia Fund did in the early 1970s.
So when you make this kind of pivot, and you always need to keep your eyes open, of course, for new opportunities. That was where we talked about the money mind, always seeing investment opportunities and being flexible. But how do you prioritize your time then? Growing your circle of competence, and you need to know what to spend your time on. It's a tough challenge to go into a new area like that.
Yeah, it's a great question. You just take the first step. That's it. You just take the first step. So, as to your point, let's say we're on this podcast, 10 years ago, and you say, Cole, what do you know about the energy business generally? And I'd say, well, I generally know they waste money, and I generally know they don't have good balance sheets. And that's what I generally know, which is nothing. Okay? Well, but again, I only went as far as I stepped. Okay? Now, so here's what happens. Okay? You watch what goes on in the spring of 20. But prior to that, late 19, Warren Buffett's buying his preferreds in Oxy. Sam Zell, another successful investor, is out buying existing production that's distressed. And then you have Peter Lynch, a T. Rowe Price kind of figure in another era, one of the greatest growth stock investors of all time in late 19 in Barron's in November of 19, saying he sees 3 baggers and 4 baggers in E&Ps, exploration production companies. And to watch the confluence of that, incredible. So you just know, okay, I need to start learning. I need to start acquiring knowledge, because great minds are agreeing in opposition to other market participants. So you just take your first step. So you start doing your work on Oxy, okay? Because Buffett's involved. Probably not a bad start. Not so risky, I would argue, from a historical context. And then you continue to plow your way in. What you end up gaining as you take each step, you learn more. Another book, The Frackers. I read The Frackers in the spring of 20. Wonderful book. Greg Zuckerman does a great job of writing about that. So that's the one thing that books give you. They can speed up the steps. And I don't think people recognize that. They speed up your learning. They speed up the process. Because by the end of all those steps that you just did day after day after day after day, you end up with what I will argue is always true. You end up with a cumulative advantage. It is not anything on its own. It's the accumulation of each of those steps. So for example, you go do that you start in the energy business, right? You start doing that in the energy business and you continue to get more and more involved. I think a segmented opportunity in the energy business is I can go out and find, back to the financial accounting thing, I can find businesses where you need to adjust the book value because the debt is so cheap and so long in duration that if you went to a banker right now and tried to buy that balance sheet, you'd have to pay billions to get that balance sheet. So I look and say, well, based on what I've learned in the oil business, that's not a liability, that's an asset. Okay. So again, but you don't start there. You can't start there. You have to build that up. Now, what has that also pivoted us to? Well, you just continue to learn from there about the energy business at large. I mean, we've done a ton of research on natural gas businesses, which we don't own an explicit natural gas producer. You end up doing a bunch of research on like coal businesses, like that part of the world that no one wants to touch, but we just so happen to have two continents, using more and more and more every day. Now, did I start out and say, you know what, I want to learn about the coal business? No, you just continue to take steps. Now, do things continue to force you to take steps? Yeah, in our case, insider buying. Insider buying causes us to take steps. Hey, what do those insiders know that we don't? Why do they like today's price? Great, let's take a step. Let's learn about that business. To use that as example, we're doing a lot of work in banking today because we see insiders buying. So you just begin to take a step. Have we ever looked at regional lenders before? No, but you're just starting to take your steps. So I think to your point, you always look back and say, gosh, I know a lot. But you can't ever say that at the beginning. Did you guys notice in the Berkshire meeting? Buffett commented on what Charlie knows about the oil business. He said in the Berkshire meeting, and I found this keenly interesting because if you said, Cole, who do you idolize? I idolize Charlie Munger. Like he is my hero. Like if you say, who's the hero of the faith that you practice? Charlie Munger. Okay. By the way, I can tell you where he doesn't practice it perfectly, which is why I know he's human. But I really idolize Charlie Munger. Buffett said in the meeting, he said, Charlie knows a lot more about the oil business than I do. So when I look at the Oxy investment, what did I say earlier? If I was the fly on the wall, Munger said, Warren, let's find just something we can sit on our ass with. And so I actually think if you said, who's really pushing the Oxy thing, I think it particularly is Munger. But again, I don't know that because I've manifested that. I know that through reading and learning and watching and experiencing, each of those steps has got me there. And you think of Malcolm Gladwell, who has talked about 10,000 hours. That's what he gets, to consider like a proficient where you know what you're doing. But in investing, that's not where you can end. I think the most dangerous thing to the mind of an investor is the idea that you've already arrived, right? In other words, that you don't need to take any more steps. That's a very dangerous and damaging place. And I think that's where people often find themselves. To use another, you mentioned a money mind. I mentioned to Robert Hagstrom that I said, well, Robert, did you know that is the name of Phil Carre's book, right? A Money Mind at 90. And here's the funny part. He didn't know that till after he published his book. No one had said, by the way, there's a title out there touching on this money mind issue. Phil Carre was a money mind into his 90s. And Buffett at the meetings would say, oh, hey, it's like the 94 meeting. Buffett would say, oh, hey, Phil Carre's here in the crowd. I want to give a big round of applause for Phil. He's a real hero. He's a hero of mine, and I want to recognize him for what he's done. Phil Carre, in my opinion, would be doing exactly what Smead Capital Management's doing. He was buying sugar at the outbreak of World War II because he knew that sugar was the most readily available form of energy out there, which means that if you need to get energy to troops, what do you give them? You give them sugar. And sugar markets took off like kind of commodity markets have. So again, it's each step, but can you start to build this mural and this, can you start to build this mosaic after you take each of those steps? That is the fun part to this. You wake up with a masterpiece after taking steps for numerous days.
I actually think that going back to the oil business and so forth, Munger was thinking about this 10 years ago, because I remember at one of the annual meetings, it might have been 14 or 15, I'm not sure, but an early ESG person in the crowd asked him about all of this, and he said that I think it would be better for humanity if we use all the commodities we have in the ground right now instead of keeping them there. So in terms of getting back to all the companies are dying, but when and how much will they produce before they die, he was on to the net present value already then, I believe.
Well, and I think to your point, I think back then he answered that because I think the question came up around Burlington Northern, them shipping, liquid natural gas and things like that across their rail lines. And Buffett commented, I think, in that meeting, he said, "Oh, we think we're gonna be delivering a lot of that." In other words, they could see that from places, moving oil from Canada down to the U.S. or down to the Gulf to be taken offshore. They could see that. So I agree. But here's what's interesting. In this meeting, he said, strategically, is it really that good for the United States to use its commodity versus use everybody else's right now? He was pretty much saying we should be willing to pay higher prices for other countries' oil because ours strategically is more valuable to us from, I'm guessing, like a strategic military perspective. So I again, if you looked at what Munger said in this meeting, it was different than what he said 10 years ago.
Right. We could get into all kinds of different topics and discussions here and sit for hours. But to sort of finish up, apart from the going into perhaps a new investment era like the end of the 60s into the 70s, what's best about being active in the market today? I mean, what do you see as the most interesting things of this time and this era?
Yeah, I mean, we just feel this is a blessing. This is an incredible era to be an investor. I mean, just as an example, I know Buffett and Munger in the meeting had said, "Oh, there's so many value investors and they're all practicing their craft." It's pretty much saying that like there's just too many people out there. I would vociferously argue against that. I think there's the least number of people practicing a true value discipline relative to the last 20 years. Okay. Now let me add one more thing to that. Here's another thing that I think we understand. So use it was just announced that Buffett and those guys were adding to Capital One Financial. Okay, so think of like, let's say you're the Sequoia Fund. It's 1970. You're in this new era. Was Sequoia Fund limited in what it could buy? And the answer was no, it wasn't that big. That is Berkshire Hathaway's biggest problem. Now, in an inversion, right? Munger says invert, always invert, right? That is their problem. That is our opportunity. So for example, if I'm Berkshire Hathaway, minimum market cap, minimum, $20 billion. $20 billion. So, okay, let's go look to the regional banking land in the United States today and say how many banks are bigger than $20 billion? There's just not that many. There's not that many today because the scale has brought the biggest to be very big, and there's not many in that 50, 60, or even down to like 25 billion. But there's a lot of names in $5 to $20 billion or $5 to $30 billion that we as an investor can go out and buy a 1% stake in, a 2% stake in, etc. But Berkshire Hathaway is limited. So it's like a card game. You're at the table, you know what your advantages are, and you can understand and think about what the other money managers' disadvantages are across the table from you. As an example, that's not just a Berkshire Hathaway problem. Go look at the biggest money management firms in the world. It's their problem. They can't plug $1 billion into an oil company or a banking institution in times of distress. Why? They're too big. If I'm T. Rowe Price today, what do I hate? Being T. Rowe Price, the money management firm, I can't be Cole Smead. I can't be Bill Smead. I can't be the investors of Smead Capital Management. That is a huge opportunity for us. It's like what Sequoia Fund would have had in the 1970s. It's like what Buffett would have had in the 1970s. And so I look at this as like, I'm so glad I'm 39. I'm so glad we get to do what we do. This is a wonderful earth. Think of all the books that we get to study alongside folks like yourself that nobody cares about. Like, why would we ever be remiss about God's green earth that he's put us into, in the era he's put us into? This is the greatest era to ever live into today. And the next year ahead will be even better when we're gone.
Good advice to my kids coming home tonight. That's for sure.
Exactly.
So besides being the CEO and portfolio manager of Smead Capital Management, you are also the host of A Book with Legs podcast, which we recommend everyone to listen to, of course. And as this is also a book podcast, we like to wrap up with a few questions about reading and writing. And I'm curious about hearing a bit more about your reading habits.
Yeah. So I have 4 kids, and I would say first off, you have to schedule it. I mean, I have to schedule my reading. I literally have to. I love vacation because that's my reading time, particularly. So I would say you have to prioritize it. I think it was a couple years ago. The Wall Street Journal was interviewing us on a day that Target was getting crushed, and Target's a holding of ours. And they said, "What were you doing?" And I said, "Oh, I was reading a book." And they said, "Really?" And I said, "Yeah, because that's more profitable than staring at stock prices." I mean, just think of how often we stare at stock prices. And we're not trying to attain profitable knowledge, which is really where we make all of our money. So, and by the way, the book I was reading at the time was George Hurst. Wonderful book. And so, little side note, I like taking my books and learning and then asking how I can, get more mentally involved. I'm going out to the charcoal kilns in Death Valley in a week and a half. That is in his book. Why? Because I want to continue to have that creativity of that book run through my mind. So I would say prioritizing it. I think the second thing is, I think you need to write about what you read, because you get all these ideas in your head. And the wonderful part about how the human body is made is when you put pen to paper, your brain functions how it should. In other words, it's not enough to just attain knowledge. You have to then organize it. Okay. And organizing the information is actually what creates the most practical abilities to make money. So, like, why are the librarians not the wealthiest people in the world? Well, because they might have read, but did they ever organize it? Did they ever put it to a practical application? And I think that's why writing is so important. So we write often. The missive we just had came out this week. It's called Good Odds and Odd Goods, where I talk about the Kentucky Derby. I talk about the favorites. I talk about, at my college, it was highly likely you'd find a mate, but they were really smart ladies in our case. So, the goods are odd, but the goods are, the odds are good, but the goods are odd was what I said. So, I think so. Reading and writing, you have to be wandering. It's almost like a book walkabout that you're on. You're on this walkabout, and you're on your own, just like you are as an investor. And you have to figure out things in an unknown world on this walkabout. And that determines whether you're successful or not. How good are you being on your own on that walkabout?
So when you're reading, are you reading one book at a time and just going through it at once, or are you reading multiple books at the same time, or how do you work with that?
I'll usually get multiple books where I get, say, 50 to 100 pages in on, and then I will then prioritize which one I'm going to finish. So, for example, I'll give you the ones I'm currently reading. I'm finishing up Easy Money. I reread aspects of John Train's book for this podcast today. The other books I'm finishing up. I'm about 150 pages into Barry Strauss's book, the war that made the Roman Empire. And then the other book I'm reading is Brett Scott's book, Cloud Money, which is kind of why do the credit card companies and crypto businesses, how do they kind of all have incentives that are built certain ways and whatnot, kind of, out there. And I'm maybe like 30 pages into that so far. So I usually like to have multiple things because you can kind of dabble. Now, another question I get asked is, if these are all nonfiction, right? These are all nonfiction books. If I really want to adventure, where do I adventure in fiction? And the answer is Hemingway. Hemingway is where I adventure. Okay, so For Whom the Bell Tolls, wonderful book. I visited Hemingway's house in Key West. This is really cool. He had in-ground lights in his pool in the 20s. I mean, this guy was super cool. And so I look at Hemingway and say, kind of a strange character, traveled the world, romanticist, but womanizer at the same time. Those are the things I don't want to copy, but interesting guy. And so I look at Hemingway and I say, I kind of like adventuring in Hemingway to clear my mind. And so that's where I go when I need to do something where it's like I need to be off kilter. I don't want to read a nonfiction book, and I need to just imagine. I go to Hemingway books.
So is there something you don't read?
Self-help books are terrible. They're deplorable. They're a waste of time. When I see them on a book stand, I just feel bad for the people that buy them. It is a gimmick. It's like buying a weight loss routine. You can read it. It's great. I know Tony wants to help you all figure out life. I would say, this is my own personal belief. I think they'd be better off buying a Bible and just keeping it on their bookshelf. They'll find way more profitable things in how God wants to cause them to flourish than they could in the next self-help guide.
Cole Smead, thank you so much for coming on Investing by the Books podcast, and especially because of your cold. I mean, you took more than 1 hour here to speak with us, so we really appreciate that, and really interesting getting into Money Masters and your investment style. Do you have something more you want to add before we finish up here?
No, I just think you guys are doing something wonderful, and I've for the listeners of your podcast, I would say, if you're wondering, yes, they're getting something out of this too. I mean, what they get to learn in these discussions is so valuable for what they're doing in their line of business. And so I want to thank your audience, and I want to thank you guys as well.
Thank you so much, and happy to keep in contact. And lastly, where can our audience follow you and the work of yours?
Well, like you said, on a Book with Legs podcast, we write often, so they can go onto our website and sign up for our missives. I have become pretty active on Twitter in the last 2 years. So my handle is at Cole_Smead. You can find me there. And I don't comment on anything. I don't share my personal life there, but I comment on anything that I think is funny or of investment value there on Twitter.
Perfect. We'll put that in the show notes. Thank you so much, Cole.
Thank you.
Thank you.
Thank you for listening to Investing by the Books, a podcast by Redeye. Follow us on Twitter at IB_Redeye and email us at ib.podcast@redeye.se. To improve, we'd love to hear your feedback, so please rate and review us. Notice that the content in this podcast is not and shall not be construed as investment advice. This information is meant to be informative and for general purposes only. For full disclaimer, visit redeye.se. I'm your host, Eddie Palmian, and until next time, I sincerely wish you the best of luck on your journey through life and investing.